welcome to Staffworks Explained. If you are here for the first time, please consider subscribing to this channel. Also hit the notification bell so that whenever you upload a new video, you are notified. In this video, we'll be talking about Safaricom, which is on the on sale 15%, and we are saying that Safaricom is on the auction block. It's a high-stakes sale that redefines Kenya's economy future. In this video, we say that Kenya is confronted with one of the most consequential economic decisions in the recent history: the government sale of a large block of its stake in Safaricom, the most profitable company in Kenya and also in Eastern Central Africa. It is the backbone of Kenya's digital economy, and it's also the custodian of M-Pesa, one of the African most powerful, not just Africa, but world most powerful financial platforms. The sale hopes to raise roughly 240 to 250 billion Kenya shillings. It will transfer effective control of Safaricom to Vodacom, and is even being justified as a way to seed major national development funds. The buyer paid about Kenya shillings 34 per share, which is above recent market prices, what officials are calling a premium. But behind the headlines lies a far deeper question. And the question is, did Kenya just trade long-term economic sovereignty for short-term cash? Safaricom is not just another company. Safaricom is not a normal listed firm. It is Kenya's largest taxpayer, one of the biggest private employers, the spine of mobile banking through M-Pesa, dominant player in ICT, e-commerce, credit, savings, government payments, data services, a systematic pillar of financial inclusion and cash circulations. On any given day, trillions of shillings of personal savings, business payments, salaries, taxes, and social transfers move through Safaricom system. This is not just an infrastructure. This is economic nervous tissue. And now, control of that system has shifted further away from Kenyan hands. Yes, the government sold at a premium. But what kind of premium? On paper, Vodacom paid a premium over the prevailing market price. Technically, yes, that qualifies as a premium. But here is the uncomfortable truth. This was a negotiated single buyer sale, not an open competitive price discovery process. That matters because the price reflects Vodacom's strategic agency, not necessarily the best price Kenya could achieve in a fully competitive market. Retail shareholders were not offered the same premium. The public has not been shown the valuation models, future dividends assumptions, or discount rates used to justify the deal. The government also accepted upfront cash in exchange for future dividend rights, effectively selling tomorrow's income for today's spending power. So yes, premium was paid, but whether it was the best possible value for a national strategic asset remains unproven. What this means for ordinary shareholders: Safaricom is one of the most widely held stocks in East Africa. Pension funds, SACCOs, SMEs, and millions of retail investors depend on it for long-term wealth. Here's a critical issue: the government sold at a premium. Ordinary shareholders did not get the same opportunity. No public buyout offer was made. Yet, control shifted. That creates a two-tier outcome. The state exits parts of its position at a strategic price. The public remains exposed to the risk of future governance, dividend policy shift, and capital extraction. Minority shareholders now face: 1. A stronger controlling shareholder, potential changes in dividend strategy, possible centralization of profits without a multinational group, and also reduced influence of a long-term direction. This is not inherently illegal, but it is structurally unequal. What this means for Kenya economy: supporters of the sales argue the money will reduce pressure on the debt, it will seed infrastructure, it will stimulate growth. That is optimistic case. Now the harder truth: Kenya has exchanged: 1. A reliable recurring dividend stream, strategic voice in its most powerful digital company, and a measure of monetary and payment influence. 4. 1 of cash injection, a promise for future projects, and funds that do not yet have bulletproof legal safeguards. This classic development finance gamble: long-term income versus short-term liquidity. If the money is managed with precision and integrity, the economy could gain. If it's mismanaged, Kenya will have lost strategic leverage, lost stable income, and gained nothing permanent in return. Now let's talk about the funds, the development tool. Is it a development tool or is it a political cash pool? The government says that the proceeds will seed 1. National infrastructure funds. 2. A sovereign wealth fund. In theory, these are powerful instruments. In practice, they are only as strong as their legal installation, their governance, their transparency, and also their procurement discipline. Right now, the most dangerous weakness are ring fencing is still fragile. Laws can be amended, funds can be redirected, future treasuries can change the rules. Oversight structure is still vague. Who appoints the boards? Who audits? Who blocks politically motivated spending? And 3, project selection is risk are massive. Infrastructure funds across the development world routinely fail not because of corruption alone, but because the poor project economics, inflated costs, and abandoned builds. With ironclad rules, the proceeds of these risk becoming 1. A short-term budget stabilizer, a political infrastructure tool, or once a future corruption battleground. What this means for M-Pesa and digital sovereignty? Let's be blunt. M-Pesa is now more clearly under foreign corporate control than at any time in Kenya's history. That has implications. 1. For data sovereignty, transaction pricing, credit algorithms, digital identity linkages, government-based systems, and cross-border capital flow feasibility. Regulators must now enforce strict data localization, protect interoperability, prevent exploitative fee structures, and preserve public leverage over critical digital rails. If those protections weaken, Kenya risks becoming a digital tenant inside its own economy. So, was this a smart sale, or a dangerous shortcut? The deal is not inherently foolish. It is a dangerous, but it is dangerous, easy to get wrong. Kenya has effectively said, we trust future governments, future fund managers, future boards to convert this cash into long-term national value. That is a huge leap of faith. In a country where major development funds have collapsed before, mega projects routinely overshoot costs, and any public asset sales rarely face post-transaction audit. The final verdict is this transaction will not only be judged by the press release, the headline numbers, or the short-term budget relief. It will be judged by a simple test. 10 years from now, will Kenya be richer, more resilient, or more economically sovereign? Or will we be asking where the money went while control of our most powerful company, Safaricom, sits offshore? Safaricom was not just sold. A portion of Kenya's economy's spine was transferred. That demands scrutiny, not celebration. Thank you for reaching this far. If it's your first time here, please subscribe to this channel. Also hit the notification bell so that whenever you upload a new video, you are notified. You can also leave a comment, like, and share. Thank you.